Welcome. Today is Thursday, February 23rd. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and founder of Alpha Insights. And this is your Daily Five. We're going to just give you a quick reminder here that our newsletter is free to subscribe to. This is a newsletter that we deliver out via email on the first Saturday of each month. So we've got one coming up here on March 4th. The newsletter is affectionately titled Huge Insights, the Big Picture. And, we usually discuss the big key macro factors that are affecting the economy and the markets in this newsletter. We also put out our forecast, kind of a month ahead forecast for those who, are more serious patrons who have upgraded to the paid option. They get access to the forecast. You can do that for as little as $10 a month. We've even offered a lifetime subscription option now, which is fairly new, and we think it's pretty good value. But that also includes our positioning recommendations, as well as our weekly top actionable trade idea. We deliver out a publication to our institutional clients every Wednesday called Alpha Insights Idea Generator Lab, and that publication is also distributed to our paid members or paid subscribers on our newsletter. This newsletter is available on Substack, hugeinsights.substack.com, or you can find it on our website at jwhinvestment.com or our Twitter handle at alpha_insights. So any of those will get you to the newsletter, and you can subscribe, sign up, and have it delivered to your email box. So that's all I wanted to do, is just give a quick reminder on that before we jump into today's presentation, which starts right now. Chart number one, the terminal Fed funds rate, okay? The CME Group's Fed Watch tool, which uses the Fed funds futures curve to calculate the probability of future rate hikes based upon market positioning, is telling us that there's been a very big change over the past week. That change has resulted in a major recalculation of the probabilities of a higher terminal Fed funds rate. And the shift has moved from a range of around 4.75 to 5% up to a new range of around 5.25 to 5.5%. That has taken out the top end of the prior, variable expectations. Now, several Fed governors have already intimated in their comments, their public comments, that a 6% level for a terminal Fed funds rate is not impossible. It's definitely on the table. And, this is a level that was predicted by JP Morgan's CEO, Jamie Dimon, last year. In addition, just looking at the March 22nd meeting probabilities, it's now, there is reason to believe that a 50 basis point hike is back on the table for March 22nd. There's about a 27% probability of that occurring at this point, about 73% probability of a 25 basis point hike. But it now looks like the Fed's looking to raise rates by another 75 basis points through at least June, based on the Fed funds futures curve. And so, under this sort of rubric, we would not expect the 10-year Treasury to remain subdued. If you take a look at the 3-month 10-year Treasury yield curve, it currently sports the steepest inversion on record, but that has actually already begun to reverse off of its lows. And so, it's telling you that, the curve is going to begin to re-steepen here. And it's interesting to me that reversal is coming as 10-year bond yields are rising. In our view, it's possible that, a steepening of the curve occurs as the 10-year Treasury yield advances. And so even as Fed funds ascend towards 6% potentially, certainly 5.5% seems to be baked in at this point. It seems reasonable to us that 10-year bond yields could certainly match the Fed funds rate at the very least and potentially exceed it. Let's look at chart number 2 for some more color on that. We've titled this chart, "The Trend is Your Friend." Why? Well, since posting an all-time record low of 0.39% in March of 2020. The 10-year Treasury yield's actually risen more than tenfold to a recent high of 4.33% last October. Now, the recent pullback in rates to a low of 3.33% appears to have completed a corrective phase, and thus far it's successfully retested a prior resistance level, which is now chart support, and the 12-month exponential moving average both came into play around 3.25%. So just based on the trajectory of the trend off that 2020 low, the subsequent advance could carry the 10-year yield to its next resistance range of around 5 to 5.5% in the weeks and months immediately ahead, certainly before year end, based on that trend. Indeed, if we just look at the pullback and project a measured move up, any sort of a sustained bullish inflection above the previous high of 4.33% would project a measured move to approximately 5.33%. It's 100 basis points in addition to the prior high. And so, we think there's a high probability of this playing out in the very near term, meaning the next, say, 6 months or so. But longer term, we think the 10-year Treasury yield will eclipse the 6% level and could go, significantly higher. So with that in mind, let's take a look at what's going on in the volatility realm. We're questioning whether or not there's going to be another volatility spike here. We've seen several over the course of the past year, usually terminating around that 34 to 35% range. One got a little bit ahead of that. The VIX actually posted a new 52-week low back on February 1st. However, the volatility of volatility index, the VVIX, actually made its 52-week low back on January 6th, and it's been diverging positively ever since. Now, historically, positive divergence between these two series has preceded sharp trend changes in the VIX, often resulting in a volatility spike of sorts. The initial confirmation signal that the trend in the VIX is reversing was actually generated when the VIX posted a daily close above its 21-day moving average. But a more reliable confirmation signal in recent years would occur if and when the VIX posts a daily close above the 24% level. That 24% over the past 5 years has acted as something of a boiling point for volatility. And we're not quite there yet. We got almost to around 23%. We've experienced a tad bit of a pullback here. That should be normal. The VVIX looks like it's kind of leading this whole volatility charge, and I suspect that we're going to see some follow through here with the VIX. I would not at all be surprised to see a volatility spike of some significance in the days and weeks immediately ahead. And in fact, I would go as far as to say that this volatility spike, if in fact it does occur, could eclipse the prior volatility spikes and may even take out the 40% level. We haven't printed a VIX spike above 40% in over 2 years. It's probably about time. Let's see how this kind of interfaces with our market view. We've been showing this chart, and this is just an update of what we showed back on February 9th when we talked about hedging. It's a good time to hedge your portfolios, and we think we caught that just about perfectly. Our preferred Elliott Wave count basically assumes that the January high in the S&P 500 index marked the end of cycle wave 5 of super cycle wave 3. Now, as a result, we think that a corrective waveform of super cycle degree may now be in progress. We've been counting the 5-wave decline into the June 17th low as primary wave 1 down of a larger degree motive wave, which we believe has the potential to carry the index all the way down to around S&P 2250 before it terminates. Under this rubric, we've assumed that the counter trend advance into the August 16th high marked the end of primary wave 2 up, and that primary wave 3 down has been subdividing an intermediate degree of trend, setting up the market for a third of a third wave decline. However, in analyzing the S&P equal weight index, which is the chart to the right, we actually find a leading diagonal that bottomed in mid-October And that may actually be a more compelling count. That low actually saw a three-wave advance, a counter trend advance, follow through into kind of the beginning of the year, right? Where we saw a 78.6% retracement, almost to the penny. And we're counting that as primary wave 2 in the equal weight index. We've subsequently broken below the 100-week moving average, and also an ascending trend line that marks that wave 5, or I should say primary wave 1 low in October with the B wave low. And so, it gives us some sense that, the trend looks like it's beginning to reverse in line with our view. Now, if it turns out that the leading diagonal pattern is also operative in the cap weight index, then the rally could carry above the August high before primary wave 2 tops, just the way it did in the case of the equal weight index. But we think that's a very low probability. And in fact, I'll just throw out one detail. We've changed our moving averages in the cap weight index to reflect the 377-day moving average. Some of you might recognize that number as a Fibonacci number, and that's right. It's actually the 13th Fibonacci number in the progression. And so if we take 377 days and divide it by 5 days in a week, we come up with a 75-week moving average. And we can see that moving average stopped the primary wave 2 advance in the cap weight index. And it looks like it's also been the terminal point of intermediate wave 2 of primary wave 3 down. If that's correct, we should see some significant follow through in the immediate future, which should take out key levels and confirm our view that we are in the midst of a third wave decline. And if that is the case, we should see the index carry down to at least 2750 before wave 3 terminates. But let's take a look at our short-term view. Chart number 5 looks at all of the price action since around August 16th, right? Just kind of looking at that decline into the October 13th low, which we count as 5 waves down at minor degree. And that completes what we believe is intermediate wave 1 down of primary wave 3 down. The advance off that October 13th low was a very choppy, overlapping, what we think is a counter trend advance, a corrective waveform. And we count it as a double zigzag, an ABCW, ABCX, and an ABCY to complete intermediate wave 2 of primary wave 3 down. That terminated on February 2nd. Since February 2nd, we count 5 waves down to minute wave 1, and then we see what appears to be a flat wave, corrective waveform that topped at S&P 4177, I think back around Valentine's Day. And in fact, the subsequent decline is progressing like minute wave 3 down. So if that's correct, once all of the subdivisions are complete, they're going to form minor wave 1 down of intermediate wave 3 of primary wave 3 down. This will confirm that we are indeed in the midst of a third wave decline. And in fact, the daily close below S&P 3885 would strongly support that conclusion. A weekly close below the December 22nd low would confirm it. And, the alternative view is simply this, that, if we were to see the markets reverse higher and post a sustained move above S&P 4230, it would definitely call this view into question. And any move above the August 16th high in the S&P, that's around 4325, that would break the current preferred count, and it would shift our focus to our alternate count. Our top alternate count now is the leading diagonal version in the cap weight index. That would have an upside potential to around S&P 4534. But we think that's a very low probability. We describe about a 20% probability to that now. We think there's an 80% probability that our preferred count is currently in progress, and we would be positioning very, very conservatively. We would maximize cash reserves here, minimize net equity exposure. We think the market is set up for a third wave decline. With that, If you would like to follow up with me and get more information about our newsletter, you can certainly go to our website, jwhinvestment.com. You can follow us on Twitter at alpha_insights. You can go right to Substack, hugeinsights.substack.com, and you can get all the information you need with respect to our upcoming newsletter. And with that, I just want to thank everybody for watching and wish you the best of luck trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.